Now we get into the good stuff here with the Dormant Volcano setup. This will be a video that goes over the trade management, and it's all broken down into a 4-step process. Given my engineering background and degree, just my mind kind of works this way anyways, but I think the best way to implement something is to break it down in steps, and then when you combine them, you get a process, and then hopefully that gives you a strategy that is not only easy to understand, but when it comes time to execute and then manage the trade, you understand what's going on and what you should look for. This video is going to be pretty darn detailed, where we'll go through 3 examples. And each example will be, with the PowerPoint slides throughout it, so it'll be step by step by step. Whereas when we get to the case studies, that'll be a little bit more rapid fire. But for this one, my goal is, when we get to the 3rd example, that you're kind of annoyed because you already know what I'm going to say it before I do say it. So hopefully we can get to that point. If you're not, that's fine. Lots of case studies to go through, or you can always just come back and watch this. But let's hop right in and get dirty. So the 4-step process, this has obviously 4 steps. The first is going to be the hunt. This is where we're going to find the technical setup that meets our criteria. We've gone through the classification setup, so you know what an extinct, a dormant, and an active volcano looks like. So when we find a dormant volcano, that's going to be part of the hunting stage, finding the actual technical setup that meets what we're looking for. Next is going to be the stalk. Now, just because we find something, that doesn't mean we go and just start buying shares. We have to wait for some sort of buy signal to occur, which is going to act as confirmation. So that's what step 2 is all about, the stalk. And then step 3 is the actual entry. When we do get a buy signal, we have to be able to form a position and get into the stock. So that's what step 3 is all about, forming a position and hopping into the trade. And then step 4, if you've taken the courses before, and have heard about the ninja. The ninja is my way just to remind myself and you that discipline is the name of the game, and we have to manage the trade properly in order to maximize the gains and, more importantly, minimize the losses. There's always going to be losses, no way around that. But as long as we can minimize those and keep those on the smaller side compared to our winners, then that's the name of the game, and that's what the ninja is all about. Ninjas are disciplined, and that's what we want to be as we go through and execute these strategies. So for our first example, our first step is the hunt, and within the first step we have step number 1, which is we need to locate charts where the MACD signal line has crossed above 0 or is equal to 0. So in other words, it's 0 or a positive number, and we want to look at the signal line as what I like to call the hope verifier, meaning if you think back to our psychological stages, we want to be at a place where hope is about to transition into excitement. We don't want to be at the early stages of hope because that's still a little too risky, and it's just kind of like walking on thin ice. We want to try to get towards the other end of the hope spectrum where it's about to transition, and the best way to do this is to look for these lines, or look for the signals where the signal line is positive and above 0. So that's going to be step number 1. So let's hop into our first example. So step 1, you pull up this chart and you say, hey, look at this, the MACD signal line. I like this because this one's literally right at 0. So 0 or positive. So we have our first step. This chart is at 0. Looking at the chart, we've gone in the classification video. Hopefully now you know that it may be confusing. You may look at this and say, hey, how is this not an extinct because of the 50? Remember, it doesn't matter. Step number 1 of the whole strategy, just think about it like that, of this entire volcano trading strategy, and it'll be same like this for active volcanoes. Step number 1 within all the steps, and I believe it's a 14-step process, is going to be what is the MACD value. So yes, all these other things are important, but numero uno in terms of importance is going to be the MACD signal line value, and here you can see it is right at 0. So step 1 complete, we have this above 0. Now remember, just because MACD signal line is above 0, that doesn't tell us what type of setup we have. It could still be a dormant or an active volcano, so we need to figure that out. That's where step 2 comes into play. We need to look at the 50 and figure out, what's the status of the 50 period simple moving average, or as we've called it, the excitement ruler. Where's the excitement at in terms of the overall flow of things. If it's trending down, then we know we have a dormant volcano. If it's been trending sideways, or if it's trending sideways a little bit, but it's been previously trending down, so let me draw that out. So if the 50 was going like this, and then we pulled up and it's looking like this, so it's previously trending down, but now it is going sideways, that is still dormant. The reason I bring that up is because when you get into the other ones, we could have active volcanoes where it's going like this, where previously it was going up, but now it's going sideways. This would be active over here, but we care about this one over here. So again, if it's been previously trending down, but now it's going sideways, it is dormant, or if it's just flat out trending down within this example, as you'll see, that is also dormant. So let's go on and check the status of the 50 SMA. So we pull up our chart, and you can hopefully see pretty clear that this thing is definitely trending downwards. So the excitement, isn't really growing or anything like that by any means. If we shrink up the chart, let's see what it was previously doing. So yeah, it's been trending down for a while. So it's not extinct because it goes back to step one. Step one being, what is that signal line? But this is a dormant volcano. So step one, checking the status of the green line here, the 50 SMA. We are working with a dormant setup. So now we know that we've located one that meets our overall criteria, and now we've narrowed it down a little bit more. It tells us it meets the dormant setup classification. Step number 3 is we need to now check the status of the 20 SMA relative to the 50 SMA. Now, if they've already crossed, then that's bullish. There's no arguing there. Now, if they're on that crash course, which I've talked about in that classification video, meaning they haven't yet crossed, but it's looking like pretty darn sure they're going to cross, then I like to call that speculative bullish because it hasn't quite crossed, but if you're speculating a little bit, you can see, okay, that's a pretty safe speculation that they are going to cross. So that's going to be still acceptable if they're on a crash course with one another. And if they haven't crossed and they don't look like they're going to be crossing, then just move on. It's step 3 would be where this process ends, just because we need to be extra safe and extra sure that the chart is transitioning out of the hope stage like we've already discussed. So let's hop into the chart and see where things stand in regards to this. So I will zoom in here a little bit. So as you can see, we have the 20 sloping upwards, this sloping down. You can see that they're going to be crossing. The 20 has already sloping upward, so that in and of itself is a good sign. And then given the way the 50 is starting to flatten out compared to being down, that's just hopefully you can see that these are going to be on a cross course. And at the end of the day, if you're not sure, just then go find another one where it's more obvious. I mean, it's not the end of the world if don't sit here and start to get gray hair and sweat bullets and start to hyperventilate because you can't tell if these are on a crash course or not. If you're not sure and don't feel comfortable with it, just move on. That's the awesome thing about the stock market. With over 4,000 ticker symbols out there, there's going to be something else that's not going to cause you to hyperventilate at step number 3 here. So just always remember that. So to me, they're going to cross. So step 3 is complete. We are, we have confirmation that we're hopefully at the tail end of that hope phase and getting ready to move into the excitement phase. Now that we have identified everything and made sure, okay, this looks like something that looks worthwhile putting onto our watch list, we now need to have some sort of trigger point that's going to tell us when we need to initiate the trade. So this is a key thing because just because we find something, we still need to get more confirmation, and that's where the trigger point comes in. And this is usually going to be a shorter term level of resistance. Now this is also an area, going back to the previous videos, where you can bend the rules a little bit. If you want to try this from a longer term perspective, that's fine. But the point being, and what's going to keep you on the path, is that you have a trigger point. So you have to have a trigger point, but for this strategy and the way I use it, I'm usually always looking at a little bit of shorter term resistance levels, and that'll make sense more as we go through the strategy. But usually they're going to be shorter term, and I use the word usually again because this, you can certainly experiment with it if you want. So a short-term resistance, this is where your general chart knowledge and ability to identify resistances is going to come into play. And to me, there's a couple different levels, and both are going to matter on how aggressive you want to be. The first one could be down here at this previous high right here. You can see price came up there and got knocked back down, and it broke intraday here but couldn't get above it, and then right there still hovering right around here. So if you're a little bit more aggressive and you want confirmation a little bit quicker, then this level right here at 225, that would be where you'd go. Me, I'd like to see them clear more of the resistances, so that my trigger point would be right here. Again, not saying this is right. It's all a matter of risk tolerance and personality between these two, but these would be the areas where I'd put my resistance right here. So that is up there at 230. So our trigger point is 230. So step number 4 is now complete. Before I get into this slide, one quick thing. Depending on how skilled you are and I guess how well your mind operates under quick acting environment, and also depending on what sort of time frame. So if you're a day trade scalper who's using a 60 minute chart, then you're probably going to want to do this right away before you ever hop into the stock. But if you're a swing trader and you're using this on the daily chart, you may have more time, and that is to identify the first profit lock point. So again, if you want to just identify everything up front, and that's how I'm listing it out here, I'm just assuming that you want to do everything up front, you can. Or if you want to just wait to see if you get filled and then identify that, this point, that's fine. That's how I usually do it. But I'm pretty experienced, and I've stared at enough charts where I can quickly identify next areas of resistance. But if you're newer or just don't want any pressure on you after you already get some shares, then just do it ahead of time. So that's why I do it like this, and that's how I would recommend it. Not everybody has stared at thousands upon thousands of charts like I have. So I would recommend that you do it in this order. Just get everything set up, get the plan in place before you ever buy any shares. So with that point, step number 5 is we're going to identify our first profit lock point. This is going to be the next resistance after the trigger point resistance. And the next resistance, that is up to you and your personal goals and risk tolerance level. So again, you can bend the rules to however fits you, but point being, there needs to be a profit lock point. That would be going off the path and breaking the rules too much. There needs to be a profit lock point, but in regards to where it's at, that's going to be in terms of your goals and risk tolerance levels and all that good stuff. And just understand that the further away it is from the trigger point, the higher risk goes up that it won't be hit. But of course, on that note, the higher the profits you will be. So it's all a matter of risk versus reward. You can put it way far away, but you might not get filled. And if you don't get filled, then obviously things aren't going to go your way. But if you keep it a little tighter, it will get hit, but you're just not going to make as much money. So it's just a give and take, and that's totally up to you. But again, point being, and what I want to drive home is there needs to be a profit lock point somewhere after your first resistance point. So pulling up the chart here, for me, right away what I see is, all right, we have this little area here. Acted as a high, and then almost as a high right there. If the break point is at 230, this is up at 237. Given this is a stock that's trading less than $3, a quick 7 cents, that would be pretty nice. So I would put my first profit lock point right here at 237. So this would be the completion of step number 5. And also take note, look at everything that we have in place, and we don't even know if we're going to get into the stock yet. We are planning the trade. This is what it means when we want to plan the trade. We know where we want to get in at because of our trigger point. Or let me take a step back. We know the context of the situation, by going through all those steps. So we know that the bounce has pretty much already happened, but this is not a bounce strategy. We're looking for something that's going to come out of the hope and surrender strategy into and lead us into excitement. So we've identified the context. Now we've identified where we want to be in terms of what's going to get us into the trade. And now we already know we're going to lock in profits initially. So it's one of those things where don't even own any shares yet, but look how much planning we've already done. And it'll become a very quick process once you learn exactly what to look for. You'll just look through these things. It'll become second nature. And before you know it, you're going to be planning the trade without even really knowing you're planning the trade. It'll become second nature to you. And that's what you want. Step number 6, this is now part of the stalk, meaning we're just waiting. It's kind of nice because you can go grab a bag of popcorn, throw it in the microwave, or however you choose to make your popcorn. And we just now enter the wait and see mode, and we remain in the wait and see mode. So this part is pretty important right here. As long as the MACD signal line remains above the 0 line, then the chart is in play. If it falls below, then see you later. Off the watch list you go. We didn't get any sort of confirmation that it was actually moving out of the hope stage. So again, grab some popcorn, but at the same time, you still gotta monitor a few things. First being to see if it breaks above our trigger point, and if it doesn't, make sure that it holds above the signal line. And as long as it does that, then again, you can keep it on your watch list. But if it falls below 0, see you later. Move on. Cut it loose, and if it pops back up above 0, then you can put it back on your watch list. But if it goes below, see you later. Now let's move forward and assume that it's looking like your trigger point is going to be broken. I say looking like because there are 2 ways to enter into the stock. So the first is going to be you buy right at or before the trigger point. So just to keep the math simple, let's say the trigger point is $10. That means you are buying at $9.97, $9.98, $10 exactly. And the pro of this is you're going to get the best possible entry point. I mean, if it breaks, you're already in. The con will be, well, is the resistance going to be broken? You're trying to jump the gun a little bit, and jumping the gun is fine, but you just have to enter that, or understand and acknowledge that, all right, you're kind of walking on thin ice a little bit, but at the same time, I mean, if it's looking like if level 2s are showing and just kind of everything is aligning itself where it looks like it's going to fall, then this can be a nice way to enter in. Now, if you're more risk adverse and just want to have additional confirmation, then you can buy on the break of the trigger point. So you're watching, and then when it breaks, all right, now you're trying to get in. The pro is you have confirmation that resistance has been broken. All right, you know that hopefully this party is underway. The con is you're not going to get the best possible entry. So that's going to be the flip side. Which way do you want to use to get in? That's totally up to you. Again, goes back to the personality and risk tolerance. But there are two ways to hop into a breakout. It just depends on how what you feel most comfortable with. So back to our example, you can see what it's been looking like, and let's go on now to the next period and see what happens. So right there, the next period, and I'm using the word period because this can be applied to any time frame. This happens to be the daily, but it can be used whatever sort of strategy you're using. So that's why I'm not sitting here saying daily, because I don't want to use that, because it can be transferred across any different time frame that you were using. So this period happens, you can see opens down here, so there's nothing that you'd care about. But then right up there's our trigger point broken right there. So this would be where we would enter into the trade. As we just went over how you get in, maybe you got in right at 228, 229, maybe at 230, or maybe you got in at 231, 232. But as you can see, as soon as you would get in, you would then put in your profit lock point right up there. So now that the profit lock point has been put into place, we now move on to step 8. So everything happens pretty quick. I know you kind of already know what happens based on that candlestick, but let's just pretend like we're at the stage where you get your shares. So immediately after you get your shares, step number 8 is you need to get your stop loss figured out and into place. Immediately. Immediately is the name of the game. But there is good news. The good news is there's not much figuring out to do. It's very straightforward. The only figuring out that may need to get figured out is if you want to experiment a little bit. I'm going to use the 10 EMA, and that's who my best friend is, and that's who you should probably start out with your best friend as. But if you want to tinker around a little bit, that's fine. But again, to stay on the path over here, remember, we want to stay on the path. You need to have a stop loss. So tinkering with this, maybe that'll take you over to this side of the path or this side of the path. That's fine. But, if you're not using a stop loss at all, then you're going to end up way up here in like a tree, or I don't know, maybe like in a rat hole or something over here. I don't know. Point being, stay on the path. But, what end of the path or what area you walk down the path, that's fine. Just make sure you have a stop loss. And this is, like I was saying, this is kind of what I envision as the ninja pathway. So that's going to be your stop loss. So let's hop back to the example. So you are now in, and you're looking, and you're saying, okay, right now my stop loss is going to be right around 209. Now to continue on with the stop loss, remember it's a moving average, so every time a period is completed, it's going to change in value. So you're going to have to be active in watching it, but that's also going to be a function of whatever strategy you're using. So maybe you can't sit in front of your computer every second of the day. Well, that's fine, because you'll just be probably watching the daily 10 EMA. So every day you can come back and check it at least once. But if you can sit in the front of the computer all the time, then you're probably using a time frame where you're going to be able to check up on it, whether that's every 15 minutes, hour, 5 minutes, whatever. But you will need to check up on it, but that'll be a function of whatever sort of strategy that already fits your time schedule, so there shouldn't be any conflictions there. And we're going to use the most recently completed period as your stop loss, and that's going to be where we need to enter in a cushion. So just for example, if the 10 EMA is valued at 1050, make the stop loss 1044. You don't want it to drop slightly below like it can do, stop you out, and then head right back up. That's what we're trying to avoid. Sometimes even with the cushion, that's what happens to you, but that's just part of the market. That's just part of trading. I mean, you can never avoid that stuff completely, but I like to put in a cushion. But I guess, really, to be honest, if you don't want to put in a cushion and you're just like, no, I want to get out right away if it breaks, then that's fine. I mean, you just have less risk tolerance than I do, but there's nothing wrong with that at all. So I guess I should make that clarification. I would say put in a cushion, but if you just want to be super tight, then it's your money. So it's your decision, and as long as the stop loss is in place, then that's the important part. So going back here, like I said, 209. But with a cushion, we could make it, 207, 208. Given, the share price, $100 stock, you're probably going to have a 15, 20, 25 cent cushion. But, when we're dealing with a $2 stock here, yeah, just going to be a few pennies. So that's all, the amount you do is all going to be dependent on, what sort of, price per share you're dealing with. So we'll just call this, during when we get in, here's a value of it, 209. So 208, 207 would be the stop loss. So step 9, you've already seen that it's hit that green line, but let's pretend we don't know yet. So we get in because it starts to break. Now the key thing here is there is no such thing as a for sure breakout, let alone anything in the market. There are no for sures. That's why we need to take advantage of taking profits. So if we get our breakout, that's great, but there's things, whether you call them head fakes or just ones where they break and then run and then that's it. There's no true power behind them. Those exist, and those are what we're trying to hedge against by putting in this profit lock point. We want it, if it's just going to be a temporary one, let's try to at least get some profits out of it, and that way, we can, minimize our, the overall trade. But of course, as you'll see, if it is a true breakout, then we certainly want to still have some shares. So, but that's the logic here: is there's no such thing as a guaranteed breakout or for sure runner that's gonna just start flying. So we need to take into account those instances where there's just really not much true strength behind it, or it's just a head fake. But the good thing with head fakes is usually they go on somewhat of a little run before completely pulling back. So when that's the case, we want to at least try to profit lock some of these areas. So as soon as the price hits a profit lock from back in step 5, we need to sell a portion of our shares. Portion being the key word. Just because you sell doesn't mean you have to sell every single one of your shares. And as I noted, if this is a true run and has some true strength behind it, we want to make sure that we still have shares. So the minimum you should sell is 25%, and that's minimum. You just want to get a quarter of your shares out of the way. So just to keep the math easy, if you owned 100 shares, that's 25 of your shares. I personally usually do 50%. I just like to get half of it out of the way. My risk tolerance level is probably a little bit less, so I just want to really combat against a possible head fake or a breakout that doesn't have any true strength. But if you're more comfortable with, hey, I only want 25 because if this thing really starts to move, then I want to have more shares, then that's fine too. But at the end of the day, bend the rules to however you want to do it and whatever makes you feel the most comfortable. So as you already saw, came up here, hit this point, so selling shares. About half my shares here, not about half my shares. If you want to do at least 25 though, so if you had 100 shares, selling at 25 to 50 shares right up here, boom. So now we already have a profit. Steps 10 and 11, pretty straightforward. We're going to just continue to adjust and follow your stop loss. Remember the 10 EMA changes after each period is completed. So that does take some monitoring. And then as soon as our first profit lock point is hit, we need to set our second one. So I wanted to use this example that we just had to illustrate a point, but step number 11 is going to be as soon as first profit lock point is hit, then we're going to set our second one. So the reason I like this example is because it was just very explosive. So depending on, maybe you were at work when this happened, so you got in and then you set this and then you went away and then, oh man, it went all the way up there. So depending on where you would have put it, you could have put it right here as a next support and you might have gotten in. However, you might not have been away and said, oh geez, I wasn't expecting it to hit 2 profit lock points in one single period. I thought it might take a couple periods. If that's the case, that's fine. So let's say you get some shares, you get your first initial profit lock point hit there and you come back. Now you can decide, all right, well, you can put it right back up here and see if it goes up there again. You could put it up here, or if you want to go up here. So this is what I mean by all about personal preference. If you want to be aggressive and try to lock in some more profits, then I'd put it right here at this area of resistance. If not, and you want to be a little bit more risky, high risk. The risk is the higher it up, the more risky it'll be. Whether it's going to even get up there. No guarantee it'll move back up that high again. Obviously, if you put it right here, your probabilities go up that, okay, it doesn't have to go up as far, so yeah, I could probably get some. Or if you're just like, what, no, I already locked in some profit, so I want to wait for this area way up here, that's perfectly fine too. This is a much riskier area to put your profit lock point. But at the same time, if it does hit up there, your profits are going to be much bigger than somebody that has it down in this area. So personal preference thing, totally. I'm going to split the difference. Let's just move our second profit lock point right there, and let's see what happens. So the next period comes and nothing happens. So we are still holding our shares. Again, the only thing that needs to change is we need to adjust our stop loss. It has now moved up to 216. So with the cushion in there, probably right around 214 is where the stop loss would be. Now, real quick, step 12. What I want to talk about here is it's an optional step, kind of. When I was putting this together, I was trying to figure out how do I explain this, because depending on your experience level, this will kind of make sense. Sometimes a stock is moving and you can just tell that, all right, this thing is flying. It is crushing through every single resistance. I understand the strategy says I should sell some more shares right now, but I mean, look at this thing. This is just flying. But that's more of a gut instinct type thing, so it's hard because I don't know how to quantify that. I don't know how to explain that other than saying that's a gut instinct thing. So what I'm going to say is use your own judgment. And what I mean by that is, if the price is really struggling to make it to this next profit lock area, so this level is being defined as your secondary profit lock point. If it's struggling to get up there, it kind of looks like it's sloshing through mud. Just it seems like it's breathing heavy. It's maybe got sand in its shoes. It's not a smooth ride. It's not just flying up there. It's just clogging along, chugging along. Then if that's the case, that's where I'd lock in another portion of your shares. Now, if you sold 25% of your shares at that first profit lock point, then this is where I'd look to sell another half of your, or 50% more of your shares. So again, if we had 100 shares and you sold 25, now you'd be selling 50. If you sold 50 at that first one, like I probably would have, now I'd be looking to just sell 25 more shares. And the goal is to have 25 shares left to ride. So we want 25% or 1/4 of your position left to just ride and see what happens. Because again, let's say it is a head fake, but it hits our 2 profit lock points. We're going to have 75% of our position that has been sold in the profit. And the remainder 25, maybe for a loss or maybe for a break even. However, when you have 75% of your position that was sold for nice solid profits, that's going to still keep you in the green overall. So that's the whole goal of that. Again, that's me. I'm not going to sit here and say you have to do 25%. Maybe you want to do 50%. Maybe you want to do, I don't know. It's all about you in your personality. But the point being, we want to lock in profits on the way up, and then we also want to keep some shares in our back pocket so that if it does, go on one of these insane upwards moves, then we still have some shares. However, on the other note, like I was saying, if the price is flying up, then you can step back from this second profit lock point and just let it keep on moving. Again, I'm not going to try to really quantify because I don't know how. It's just one of those things where you get a gut instinct. If you're watching the charts and you can just tell, that it's flying up, then you can step back. And at the end of the day, if you're not sure, is this flying up or isn't it flying up, I can't tell, then lock in profits. If you're unsure, just lock in profits. I mean, you're never going to go broke putting money in the bank. So if you're unsure about step 12, always default to locking in profits. So now that we have step 3 explained and we know that we have our second profit lock point up there, I'm just going to assume for the sake of argument, since I don't really know how to explain it, we're just always going to sell at our second profit lock point. That's just the way that it's going to be, just because it's one of those things where I don't know how to say, oh, you should have held here or you shouldn't have held here. It's just it's an experience thing, so that's kind of what you need to go with. So you can see here the next period, then we started to get some life. Nothing in terms of profit lock points, but at 10 EMA moved up, so 221. So now our stop loss is right around 219. So as you can see, the amount we're willing to risk at the beginning originally was down at 208 area. Now we're up to here. So our loss every single passing period, our potential loss and the amount we're willing to risk decreases and decreases and decreases, and eventually it'll be where even if it does hit our stop loss, it'll still be in the green. But also remember, keep in mind at this point, we've already hit 1 profit lock point. So see what happens the next period, and there we go. So the next period is hit, and as we've already discussed, step 12, another portion of your shares are here. I'm just going to use, you still have 1/4 of your shares left for the whole entire strategy and all the videos to come. But again, just to reiterate, that's going to be up to you. If you want to have 50% of your shares still left, that's fine. But for argument's sake and just for the video's sake and example's sake, I'm just going to always go by the rule of selling 50 at first and then another 25 up here. So our entry was down here at 230. We've now locked in profits up here around 237 and then 250-ish. And now it's just a matter of sitting back and letting this thing ride. So right here, our stop loss is now at 228, or our 10 EMA is at 228. So right around 226 would be the stop loss. Next period comes, and you can see that. So here's the key thing now. Our stop loss is now above where we entered at the 230-ish area. So even if we get stopped out, the remainder of our shares are still in the green. So it is now officially 100% profitable trade for us. This candle here happens, continues to move up. I'm not going to point this out. You get the point. Every single candle after it's done completing, this will change value. So another one. Now you can see it's at 250, 253. Here's a good example of why you want a cushion. You can see it came down there. Didn't quite hit it, but bounced back upwards. So the last thing you'd want to see is a candle like this and then have it just skyrocket back up. However, the next candle right here, you can see would have stopped us out of the remainder of the position right around the 250 area. So for this dormant volcano, you can see that located the potential moving out of hope into excitement, and this was certainly a nice little area of excitement from 230, then to 237, then to 250 profit lock areas, and then the remainder up here stopped out around 250. But at the end of the day, if you wanted to lock out some more shares up in this area, it's your money. You could definitely miss out. What's the con of the pro is obviously that you're getting some real solid profits way up here. The con is that this doesn't happen and it just keeps on moving, and then before you know it, it's up at $3.50. So that's that's the pro and con of everything. So it's really up to you. But sure, you can lock in profits up here, but the point is we want to hang on to some shares just in case a move happens where all of a sudden it's at 350, then 375. We're always looking to hit a home run, but we want to do it very smartly and not with all of our shares. We hit a single down here, and then we kind of hit a double, and then maybe you could extend it up to a triple or here. But if you're hitting a triple and selling the remainder of your shares, your chance at a home run is now gone. If you're fine with that, then sweet, then that's perfectly fine, and you're good to go. But just understand that if you're selling up here for that triple, your chances of a home run have just been eliminated. But like I said, if you're cool with that, then go with it, make it work. And then step 13, we already saw play out. It's not really anything special. It's just simply telling us to continue to adjust that stop loss. TMA is that 10 EMA is gonna change after the period. And really the best way to look at it is, and I probably should have done the slide first, but the 10 EMA or whatever stop loss moving average you decide to use, it is like your tour guide. So you need to follow your guide. The guide's going to keep you on the path, and as long as you're on the path, it's going to be the path of profitability. I like that. I just came up with that right now. So we want to stay on the path of profitability, and our tour guide, who is the 10 EMA, is going to do that for us. All right, now on to our second example, and hopefully these slides look familiar to you. So step number 1, we need to locate the signal line and that hope verifier and make sure that it is at least 0, if not higher. So we pull up this chart, and the first thing you see down here, MACD signal line 0.01. So we are officially in the positive. And on that note, just some general chart knowledge, you can see the price has been going sideways, yet we have this nice positive divergence here. So this may be a dormant volcano that's got some rumblings going on. So nice little first sign there with being positive and also having the nice positive divergence. Step number 2, what is the excitement ruler doing? We need to look at that 50 SMA. Again, if it's trending down, it's dormant, or if it's trending down after having been sideways, then it's still dormant. Remember, at step 2, we're not sure. Is it an active volcano right now, or is it dormant? So that's what we need to figure out at this point. Looking at the chart, hopefully that's relatively easy to see. The excitement has been dwindling here, but maybe the excitement's getting ready to turn around. So this is certainly a dormant volcano. And then what is the status of our 20 SMA relative to the 50? If they've already crossed, bullish, awesome. If they're on the crash course, then we have a speculative bullish status. If neither, and they don't look like they're going to cross, or I mean, if neither of them are even, uptrending or anything like that, then, well, the 50 is not going to be uptrending because, this is a dormant. So I should have, what I meant to say was if the 20 SMA isn't really uptrending or anything, then, we're still a little bit too early on in the hope stage probably, so we just need to move on. So let's go check out the status of the 20. In this case, no needing to dissect or, get out the microscope. Are they going to crash course or anything? Not need to be done. You can see the 20 is now up above the 50, so everything is just a flat out bullish, little setup here. No speculative bullish or anything like that. 20 above 50, good. For step number 4, we now need to figure out our trigger point. So that's where we go into our toolbox of identifying resistance levels. And like I said, usually this is going to be a shorter term resistance level, but you can wiggle around that one if you want. Now again, depending on how aggressive you want to be with this, you could put it down in this area, and that would be perfectly acceptable. I could see why you would do that. Resistance kind of here, and then here again. However, there's kind of some wishy-washy area over here. So for me personally, I'd want to see it clear out of this little wishy-washy stuff. So I just make the trigger point right up here at this high, which is at 2087. So 2087 would be my personal trigger point area. But again, if you wanted to, if that wishy-washy stuff didn't bother you, then you could totally, I could see it, being down in this area too. But for this example, I'm going to have it right up here to make sure it clears out of all that little kind of back and forth action. Now that we have our trigger point in place, we need to figure out our first profit lock point. So that's just going to be the next resistance after our trigger point. And the next resistance that's like I've said, is going to be up to you and your personal goals and risk tolerances. The further it is away from the trigger point, the higher risk it is. But of course, the higher risk, the more money that you'll make if it does go up and hit that. So let's get our next profit lock point, or I should say our first profit lock point. So for this, being that it's usually a shorter term profit lock point, I'd do it right around here. You can see that this was an area of support at one time, and now that the price is below it, it is a level of resistance. So my first profit lock point would be right here around the 2131 area. On to step 6, at this point, this is where you grab that bag of popcorn, throw it in the microwave, and we go into wait and see mode. Again, as long as the price remains above, or I should say, as long as the MACD signal line remains above 0, then it remains in play. If it falls below 0, kick it off the watch list and move on and find something else. Step number 7, I won't go over this in detail again, but you understand the two areas. We have the at or before the trigger point, or you can do it right on the break. The one's going to give you the better entry point, but it's riskier because the break hasn't even happened yet. The other is going to be give you not as good of an entry point, but at least you know that you have confirmation that a breakout does seem to be underway. So now let's see what happens. This next period right here, you can see goes up. So there is where you are triggered in. Unlike the last example, this it didn't explode up here and then go up and hit our next profit point. It did get us into the trade, so now we need to make sure and monitor that stop loss. So like I was saying, we are in step 8, get the stop loss figured out. But as you know now, this figured out, that's a little bit of a wrong term because we have our best friend, the 10 EMA. So we're going to use that to keep us on the ninja pathway and to keep us disciplined. And then we're going to also have that cushion that is up to you if you want to, depending on how big you want to make it or if you want it at all. But that's going to be step 8, and it's a very crucial one. Right after you get filled, right after you get those shares, we need to get that stop loss put into place. So as you can see, up here was the fill, and then I'll zoom in a little bit more. Then down here, the 10 EMA is at 2047, so a cushion 2043, 2042, something like that, right around that area. We're obviously at talking about a price per share now above 20. So unlike the previous example, you could a nickel or 10 cents. That's not anything too crazy, but that's totally going to be up to you. Point being though, need to acknowledge our 10 EMA now, as that's going to be our stop loss point. Step number 9 is just going to be to get that first profit lock point. I'm not going to go down each and every bullet points as I've already gone through here, but remember the rationale here. There's no such thing as a for sure. We want to take advantage and at least lock in some profits in case it's a head fake or doesn't have any true strength behind it. And just through the remainder of the videos, I'm always going to just talk about selling 50% of your shares up front. But if you want, you could totally do 25. That's the kind of the minimum that I would say. All goes back to bending the rules and getting doing whatever makes you feel most comfortable. So let's see what happens here. Remember, we already have our shares. And then this crazy day happened. So this is a good example of why we have that first one in there on first profit lock point. But it's also a great example of why we have our 10 EMA as our stop loss. So it goes up there, and we are now filled for a portion of the shares. In my case, half my position is now sold for a nice profit. However, it comes down, and you may be thinking, well, geez, it looks like this party's over. But remember, it has not violated our stop loss down here, so you should still be holding shares. So when this is now taken, or I should say when this order is now filled, this is when the second profit lock area goes into play. For me, if you raise that up there, you can see right here, acted as support and then resistance. So right up here around the 2179 area would be now where my second profit lock point is. Again, nasty kind of looking candle here. However, it's maintained above our stop loss, so we would need to stay in. And then you can see right there, it makes a nice recovery. Still has not hit our stop loss. Pulls back, but our stop loss still has not been hit. And again, as each period completes, our risks that we're allowing or are willing to risk, let me put it this way, the amount we are willing to risk decreases and decreases, and pretty soon it will be positive. So you can see, keeps on creeping up. And then here, keeps on creeping up. Now we're at the point, though, where even if it hits our stop loss, it is going to be a positive trade for us all the way around. So this is always a nice kind of relieving feeling and good feeling when our stop loss gets up above our entry point. And then right here is an example where potentially you may want to hang on. You know, it was a gap up, so you're thinking, well, geez, if this is a gap and run, maybe I don't want to sell shares. But for this example's sake, this would be where our next profit lock point is hit. So now in my case, I would still have, if I had 100 shares, I would have 25 shares left. I would have 1/4 of my position left, and now it would just be a matter of following up this stop loss here. So step 10 and 11, we've already gone through those, but hopefully you're getting it. You know, step 10 is just always following the 10 EMA. You know, I probably don't need to put that in there, but I just want to drive home the fact we need to monitor that at all times and keep updating that. And then step 11 was putting that next area of resistance up there as our second profit lock point. And then step 12, talked about that. That's the optional one. You know, you got to use your gut instincts. And then finally, 13, now that we're on this stage, we have 25 of our shares left, a fourth left. It's just a matter of following our friendly little tour guide over here and seeing where, you know, he takes us. So we have our tour guide. You know, picture his nice little face right there. And let's see where this takes us. I should note that, you know, if you wanted to be a little bit more riskier and wanted to have, you know, your second profit lock point up here, which would make total sense because you can see there acted as support, and then it failed, so it would turn into resistance. Boom, right there, you'd have gotten more of your shares filled for a bigger profit. So that just shows that it's really up to you. But the point is, though, that we want to be locking in profits on the way up. Our stop loss here, so our tour guide, again, well up above where we entered in. So even when we get stopped out, it's going to be for a winning trade. So at this point, you could have sold up here to hit that triple, but I think we should try to go for a home run with the remainder of our shares and see what happens. You can see it pulls back here. Right there, excellent example of why you need a cushion in there. Although it didn't quite hit it, you can see what I mean. This is what we want to avoid, having it come down, get right around this area, and then bounce back up on us. We don't want to see anything like that happen, then have it turn around and go back up. Our stop loss continues to creep up. And then right here, we would have been knocked out of the trade. So it wasn't a home run, but you just never know. So sure, you can look back and see, if I would have sold the remainder of my shares up here, that would have been a much better trade than holding on. And yep, I cannot argue that point. All I can say is there's going to be times where all of a sudden you sell out here, and then you look back at it, and now all of a sudden the stock's at $26, and you're thinking, well, if I would have hung on, I'd still have shares. So it's a give and take thing. But another example here where it wasn't a home run, and that's why I want the attitude to be. It's not; these aren't going to always be home runs, but we were going to play for a home run. But you can see in the quick little moves here, in the quick time period, we were able to lock in a couple of nice size profits, and then get stopped out for the remainder of our shares at a nice size profit. And if you notice, the key word there that I kept using is profit. So that's the idea of these volcano trades. If we get some sort of rumbling and then an explosion, we want to hop onto it. But just in case it's not a true explosion and a true eruption, we want to at least try to be getting still some of our profits taken off the table. And now for our final example, you're probably getting sick of these slides, and I promise it'll be the last time you have to go through them. But step one, in the hunting stage, we need to locate the charts where the MACD, where that signal line or hope verifier is either at 0 or above. So let's look at that and make sure our next example has that. Sure enough, down here you can see that we now have another example where it's actually at 0.00. So although not positive, it's not negative either. So that's good enough. So step one complete. We have a potential play here. Now it's just a matter of, is this an active volcano or a dormant volcano? That's what we need to figure out next. And that's what step two is designed for. By looking at the excitement ruler or the 50 SMA, we're going to be able to tell whether or not it's dormant. Again, if it's just flat out trending down, then that's a dormant. But if it's been trending, or if it's trending sideways but has previously been trending down, that's also going to be dormant. So in this example, that's exactly what I'm talking about. Right now, the excitement ruler, the green line, you can see is going sideways. However, previously, you can see it was trending down. Therefore, down to sideways, it's still a dormant volcano. So that's an example of one where if it was previously trending down but it's now going sideways, then you have to give the bias to being dormant and not an active volcano. Step three, so what's the status of the 20? If it's above the 50, then it's bullish. If they're on that crash course, then it's a speculative bullish. And if it's neither and they're just not looking the way you would want them to, too early in the hope stage, so move on. And then again, just to drive home if you're unsure, also just move on at that point in time. So looking here, let me zoom in some more. You can see that not only is the 20 above the 50, but they're actually both now starting to move upward. So no doubt here we are at the tail end of the hope stage and maybe even already starting to cross into the excitement stage. Now that we have all that verified, we just need to find our resistance levels, and that, I should say our initial resistance level, and that'll act as our trigger point. So for this one, what just really makes sense to me is just dropping it right there. You can see that the price hit $3 here, and then $3 here, 2 periods in a row. So for whatever reason, this $3 point seems to be that key level of resistance. And then step 5, I'll jump ahead of the slides a little bit. Step 5 is identifying that first profit lock point. So to me, the first profit lock point would be up in this area here. You can see the last time this went on, well, this dead cat bounce here, that's exactly what that was. And this is exactly why we need to have confirmation. So a good example of why we're not trying to catch knives, because this is what can happen. But the next profit lock point would be right up here at the top of the dead cat bounce. And that's up there at $3.10. So our initial, move, we'd be looking for a 10% profit. Like I said, skipped ahead. So during the hunt stage still, step 5, we want to get that first profit lock point. That's going to be above the trigger. And the higher you are above that trigger, the higher the risk goes. But of course, the higher the profits could potentially go too. And now we are at the popcorn stage. We just got to wait and see. First, looking to see 2 things. First, if our our trigger point is broken, and then second, we want to make sure that the signal line remains above 0. So that's what we're doing and spending our time with. And step number 6. If the time does come where we have to enter in, keep in mind our two ways to enter in. One is riskier than the other. However, the other one does have a little bit better confirmation. Like I said, I'm not going to spend much time on these, but I still do want to go through each and every one. So, pick what entry strategy you feel most comfortable with. Now, when we do get in, goes back to the stop loss, our tour guide. Hopefully, I'm really starting to drive this in. We want to stay on the ninja pathway, and your best friend for that is going to be the 10 EMA. Remember to put that cushion in there. The cushion will be up to you in terms of how flexible you want it to be. But the point being, there needs to be a stop loss in there. It doesn't need to be a cushion, but there certainly needs to be a stop loss. So now hopping back to the example, let's just let things play out here a little bit. So you can see right there, entry is made into the chart. Stop loss down here is now put into place based on the 10 EMA. This is what we're willing to risk at the beginning, but we're also looking to hedge our risk by quickly locking in some profits if it can hopefully explode up there and fill some of our shares. So you can see next day does not hit that, but hey, at least our stop loss continues to increase and decrease the amount we're willing to risk. Here, perfect example of why you need to have a cushion. You can see it got down pretty darn close to our stop loss. Didn't hit it though. So good example there, although it didn't quite hit us up there at our profit lock point either. But at least our now you can see we got in at 3. So our stop, we're about 5 cents in. So our risk now is at a nickel, and with each passing period, our risk is just going to decrease more and more. And then here you can see came up here, actually gapped up above our profit lock point, so we could have gotten a little bit better area in there. So that would have been where we got filled for that first profit lock point. And that is step number 9. Again, we know the theory behind it, know for sures, and we want to take advantage of any sort of quick upwards movements. And if they're not quick, then we certainly want to start to lock in stuff if we're kind of waiting a little bit longer than we would like to. After we do get that first profit lock point, we're going to want to continue to follow that stop loss, which is the 10 EMA. And then when we do get that second profit lock, we are going to want to set that second one right away, so that way we have an idea of where we should lock in some more profits if it continues to move in our direction. So back to our example, as you can see, no other history over here, so we're gonna have to scrunch up the chart some more, figure out where would be another good area. And to me, the next profit lock point would be good right around here. You can see acted as support multiple times, and then when the price did fall below it, turned right into resistance there. So that area is right up around the 324. So 324 will be the next profit lock area. If you wanted to be a little bit more risky, and you could move it up to there, but that's totally up to you and your strategy. For me, I'd be right down around that area for the second profit lock point. So let's just see what happens. Next period, there it is right there. Out of curiosity, let's see if the more risky people would have gotten filled. Nope, they would have still been in, but you can see right here. So I'd be on the remainder of my shares after this point, and now I'd be looking for the home run. You can see our stop loss is now up here at 307. So now even if the price pulls back, worst case, even the stop loss shares that we get sold, those are still going to be for the profit, or in the green for profit. So our next move here. Now here's an example where you might see this candle and say, you know what, that's not a good candle. I don't like that. And just real quick, out of curiosity, did these people get hit yet? Yep. All right. So these risky people, they would have finally got filled right up here on this candle. And as you can see, no surprise that this area of resistance is forcing or causing this sort of candle. But I could have seen people, and like I said, I'm not saying this in a negative way, just as an example, because we've had examples previously where you sell up here for the triple, let's say, and now you're gone from the home run. But in the previous 2 examples, that was a smart move to sell up here and just lock in the triple. But now let's see what happens. So you get this candle, you're like, I'm going to get out. That's fine. But if you're following this strategy, to a T, and by every rule, you should still have some shares here. So you can see there, price pulls back a little bit, get some upwards movement, and as you can see, it keeps going up. So now we're at a stage where these people sold down here around this area. However, the people that held, their stop loss is now above where those people got out at. Great example here. Look at that. Actually, let me zoom in some. You can see price came down there and hit right basically at the stop loss. The low of this candle was at 335. The EMA was at 336. So that's why you want to have at least a couple pennies, few pennies area of stop loss. Although right there it did get stopped out the remainder of the way there. And then you can see started to roll back over. But the people that had sold here, if they would have stayed in with their stop loss, they'd have gotten more profit, and potentially even more profit had they, decided, what, this is what I'm gonna define as a home run way up here. This is what I'm gonna define as my triple up there. So it's all give and take, and every trade is gonna be different. But point being, if you follow the rules, hopefully you can see that no matter how you play it, there's gonna be profits available. Now the amount of profits is gonna vary, but they are gonna be available, or they are gonna all be there, and there's gonna be opportunity for them. So that is the 3 examples. If you're still feeling a little bit like, I wonder how this is all supposed to go, put on your seatbelt. I'll have plenty of case studies that we can go through now, and they'll be quicker than this. I'm not, no more PowerPoint slides where it's, I keep repeating myself. Now it gets into more just hopefully kind of annoying you, so you know exactly what's I'm gonna say. But at the end of the day, the key things, remember, are finding stocks that are at the end of the hope stage. That's the first thing. We do that by our MACD signal line. Then we need to make sure whether or not they're dormant or active, and that's where we use our excitement ruler, the 50 SMA. After that, we need to figure out our trigger point, because that's going to be what our buy signal confirmation is, just because it's the nice setup. As you know, during the stalking stage, that MACD signal line could drop back below 0, which means it was never a good setup to begin with. So that's why we need to monitor that and need to know what to look for to get in. And then the very important stuff starts, where it becomes the profit lock point and then the stop loss. Stop loss is the most important, but we also want to be somewhat aggressive in those profit taking at first. So that's where you're going to want those profit lock points in there. So that's what the dormant strategy is all about. We want to get in, get out a portion of our shares, and then really go for that home run with the remainder of them, and kind of sit back and let the market work for us. So the next couple of videos we'll have plenty of case studies, and that way you can get a good variety of applying this dormant strategy.